Welcome and thank you for standing by. All lines have been placed in a listen-only mode for today's presentation. The call is being recorded. If you have any objections, you may disconnect at this time. I will now introduce your conference host, Megan Tenty. You may begin.
Thank you. Good morning, everyone. This is Megan Tente, and as a tax-designated federal officer, I would like to call this meeting to order. We're looking forward to today's presentations and tax vote. Before we begin, we have a few issues to cover related to the teleconference. Tax members and presenters, please keep your phones on mute when you are not speaking. If you'd like to be recognized during a discussion, please message myself or Tax Chair Richard Gorelick via the WebEx app. Chairman of the TAC, Richard Gorelick, will lead the meeting today. But first, TAC sponsor Commissioner Quintens will give his opening remarks.
Thank you, Megan. Welcome, everyone, to today's Technology Advisory Committee meeting. I'm pleased to welcome the chairman and my fellow CFTC commissioners, CFTC staff, our full committee and subcommittee members, and the general public to what will be, again, a fascinating and illuminating conversation. This is the 7th meeting of the TAC since I became the sponsor of this prestigious committee back in the fall of 2017. Since then, the TAC formed 4 subcommittees to assist its work: the Automated and Modern Trading Markets Subcommittee, a Cybersecurity Subcommittee, a Virtual Currencies Subcommittee, and a Subcommittee on Distributed Ledger Technology, all of which have been incredibly active. We've received recommendations embraced by the full TAC from the Cybersecurity Subcommittee that the CFTC publish a statement recognizing the FISC profile, which the agency subsequently did. And today, we may receive a second recommendation from the TAC on data protection initiatives in line with the Cybersecurity Subcommittee's presentation from our last meeting. The Algorithmic and Modern Trading Market Subcommittee has been critical in understanding the implementation of best practices for automated and electronic trading risk controls by both exchanges and firms. Over the course of the past 2.5 years, we heard presentations from TAC members, from trading professionals, from FIA, from CME, and from ICE on how risk controls have continued to evolve and help ensure the integrity of the market and prevent unmitigated losses or uncontrolled trading. We heard our own CFTC Market Intelligence Branch staff present a report on the lack of volatility associated with increased automation of market trading across futures contracts. We also heard feedback from that subcommittee on the risk principles for electronic trading proposal that the Commission published earlier this summer. And in line with that feedback, I'm very pleased the Commission adopted a final rule just last week, making only minor changes to the original proposal, and recognized that regulation around electronic trading risk controls should be wholly principles-based. Indeed, prescriptive specific rules in this area are actually provide a disservice to the markets, as opposed to the idea that they actually enhance its resiliency. I would note that it's been 10 years since the last flash crash with major and material market implications. It hasn't been 5 years since the last one. It hasn't been 1 year since the last one. It's been 10. The reason it hasn't been 5 years or 1 year since the last major flash crash is not because we've had significant prescriptive risk control regulatory requirements. In fact, we haven't. It also hasn't been because of luck. Rather, it's because throughout that time of the hard work of technologists and risk management experts in the private sector, from exchanges to trading firms, in following the incentives to
Thank you for calling the conference center. At any time during this message, please enter your passcode followed by the pound sign. If you are a participant, you may hear music until the leader activates the conference. Thank you for calling the conference center. At any time during this The passcode you are attempting to enter, 67547474, is invalid. Please confirm your conference information and try your call again, or call your conference leader for assistance. Thank you for calling the conference center. At any time during this Your passcode has been confirmed. You will be joined in listen-only mode. The conference is being recorded. If you object, you may disconnect now.
The astute leadership of our designated federal officer and the associated designated federal officers coordinating and facilitating the subcommittee discussions. From the ADFOs, Scott Sloan, Phil Ramundi, John Coughlin, and George Harada have all been invaluable to our meetings, presentations, and thinking, and are the highest quality of expert and thoughtful public servants. Today, I'd just like to say will be George Harada's last meeting as the ADFO of the Virtual Currency Subcommittee. He's been a huge asset, a wonderful brainstormer, and a happy warrior in the discussion of these critical issues. And I'm very pleased to announce that Melissa Nettram, the head of Labs CFTC, will take over George's role. There's long been a strong partnership and synergy between the work of Labs CFTC and the TAC. Dan Gorfine, Melissa's predecessor at Lab CFTC, was the TAC's first designated federal officer under my sponsorship. I'm pleased that Melissa is continuing that strong tradition, which will only enhance each group's thinking and work. And I'm, of course, very grateful for the work of our current DFO, Megan Tante, who coordinates, troubleshoots, and provides uncompromising leadership for the TAC. Her hard work, creativity, and spirit are enormous credit to the agency and to this committee. But out of the 65 plus members that I just recognized of the TAC and subcommittees, there's one I would like to recognize in particular. Richard Gorelick has been the TAC's chairman for over 2 years and has always provided a steady hand, a knowledgeable viewpoint, trusted advice, and a quick wit to our internal and external discussions. Richard has also served on 2 subcommittees, the Virtual Currencies and the Automated and Modern Trading Market subcommittees, and has chaired the first as well. Richard, it's been a true privilege to have you in this role. And now I'd like to have the TAC leave us for 2020 and perhaps my sponsorship on a very high note. We have a remarkable, fascinating, and in-depth presentation on the DeFi space today, an area that has seen explosive growth, innovation, and a lot of confusion, as well as a representation and proposal for a vote on its recommendations by the Cybersecurity Subcommittee. I'm very much looking forward to today. And without further ado, I'll send it back to you, Megan.
Thanks, Commissioner Quintens. We'll go to the other commissioners for their opening statements now. We'll start with Chairman Tarbert, if you have any opening remarks.
Yes, good morning and welcome everyone to this Technology Advisory Committee meeting. I'd of course like to thank Commissioner Quintens and his staff for convening the meeting. I'm also grateful to you, Megan, for being the designated federal officer for the TAC, as well as for your work in support of the committee. And of course, I must thank Richard Gorelick for serving as the TAC chair, and all TAC members for taking the time to share your powerful and valuable perspectives. In the past 17 months, I set ambitious goals for the CFTC to adopt rules that will help promote the integrity, resilience, and vibrancy of U.S. derivatives markets. I also laid out a plan to provide greater clarity to our innovator community. I'm very proud to say that with the help of my fellow commissioners, members of this advisory committee and its subcommittees, and so many others, we've met those goals. As Commissioner Quintens mentioned, just last week, we finalized risk principles for electronic trading. Staff from our Division of Market Oversight, working with many members of this advisory committee, including our exchanges and trading firms, crafted a regulation that will set us on the right path to dealing with our ever-changing markets. The principles-based regulation focuses squarely on the risk associated with electronic trading, but it does so in a way that will ensure responses to those risks will evolve as the risks themselves do. In particular, I'd like to thank Commissioners Quintens and Berkovitz for their work on the electronic trading risk principles rule. The bipartisan effort to make our regulations workable while achieving our important regulatory objectives is a testament to the cooperative spirit of this agency. It's also a tangible demonstration of the benefits of having an advisory committee like the TAC. Given how important our 5 advisory committees are to the work we do here at the CFTC, I'm pleased to announce that we'll be having an open meeting in January that will focus on each of our 5 advisory committee chairs presenting their accomplishments during 2020 and their plans for the advisory committees for 2021. Once again, I'm very grateful to all of you for your help in advising the CFTC on how we can be a more effective regulator. Thank you.
Thank you, Chairman Tarbert. Commissioner Benham, do you have any opening remarks? Commissioner Benham might have an issue joining. Can we go to Commissioner Stump?
Thanks, Megan. I don't have any formal remarks. Like Chairman Tarbert, I very much appreciate Richard Gorelick's leadership and Commissioner Quinten's leadership and your amazing organizational skills as we enter 2021. I know that there's much more work to be done, but I do want to reflect on the amount of energy that Commissioner Quintens has brought to this committee, and I think it's really been a testament to his interest in leading in the innovation space, and that's so important for the CFTC and the industry, and so I just wanted to take a moment to thank him personally. But I have no formal opening comments. Thank you.
Thank you, Commissioner Stump. And Commissioner Berkowitz.
Thank you, Megan, and good morning to the committee and my fellow commissioners and all the participants in the conference. I too don't have any formal remarks. I also would like to express my appreciation to Commissioner Quintens for his leadership of this committee. This committee is an incredibly important committee, and I very much look forward to the presentations today. I thank the participants in advance for the presentations, which I'm very much looking forward to. Of course, thank you, Megan, for all the work you put into this. I know from my work on the Energy and Environmental Markets Advisory Committee how much work the DFO puts into this on top of your normal duties, and you've certainly been busy with critical rulemakings as well as your service to the committee. So thank you for this additional volunteer service. It's a real testament to the spirit of the CFTC staff that despite all the challenges, people step up above and beyond the call of duty. I thank you, Richard, of course, for your Richard Gorelick, for your leadership and chairmanship of the committee. Again, I'm very much looking forward to the presentations. Thank you very much.
Thanks, Commissioner Berkowitz. We'll now turn the meeting over to Richard Gorelick to start the presentation.
Thank you, Megan, Commissioner Quintens, Mr. Chairman, commissioners, and everyone participating today. I am looking forward to this morning's very timely sessions. To get the meeting started, we will begin with the presentation from the Technology Advisory Committee's Virtual Currency Subcommittee. This subcommittee is presenting on the growth and regulatory challenges of decentralized finance. Specifically, the subcommittee will discuss the growth of DeFi, a broad category of emerging smart contract-based financial services being built on top of blockchains, and will highlight areas of development, detail potential regulatory challenges, and think about possible solutions. Presenting for the subcommittee this morning will be Aaron Wright, Clinical Professor of Law at Cardozo Law School, and Gary DeWall, Special Counsel at Catton Munchin Rosamond LLP. I'll turn it over to Gary and Aaron.
Thank you, Richard. And again, we'd like to just, on behalf of all the subcommittee members, thank Commissioner Quintens for his leadership of the TAC and his support of the TAC. I always will have a warm spot for Commissioner Quintenz as a result of his citation of a Kurt Vonnegut short story, Harrison Bergeron, from Welcome to the Monkey House in response to a proposal by a specific exchange to have speed bumps potentially introduced. Creative, wonderful, but I think it's a testament to Mr. Quintenz's broad breadth of knowledge and the kind of leadership he's brought to this role. We also like to thank George, who has shepherded us through many subcommittee meetings with wit, with wisdom, and just with absolute perseverance. And we look forward to working with Melissa in her new capacity. So, Aaron, we've got a good topic here today, DeFi, and I'm going to ask you right off the bat, what is DeFi, and direct Megan to page 2 of the slide.
That's a great question, and I wanted to just echo what Gary and Richard said. Thanks so much for the opportunity to go through such an important topic. So DeFi is an exploding part of the blockchain ecosystem. It's growing incredibly quick. At their core, or at its core, DeFi protocols use smart contracts to create financial services and other products that aim to be non-custodial in nature. They ideally don't rely on one central party, but in practice, many still do.
And you referenced the word smart contract. Maybe for everybody, you can just sort of explain what that is.
Yeah, absolutely. Smart contracts, they're a bit of a misnomer. It doesn't necessarily mean, some sort of interactive legal agreement. Instead, you can think of a smart contract as a small bit of computer code or computer script that's running on a blockchain. What's interesting about smart contracts is that each node on a network, blockchain-based network like Ethereum, will execute a portion of the smart contract. So once the computer software or script is deployed onto a blockchain-based network, it's difficult to remove that software from being interacted with end users. It's difficult to also stop a smart contract-based system from running if it's being interacted with by users.
And what's some of the basic jargon associated with DeFi?
Yeah, and let's proceed to the next slide, if we can, please. So like many other areas of blockchain technology, there's a lot of jargon that's here. So to set the table and just to level set, we're just going to introduce some terms, which we'll refer throughout the rest of the presentation. So DeFi applications are often administered via online portals. Developers call these dApps, and they're often supported by individuals or entities that pool together assets into what's known as a liquidity pool. And we'll unpack that a bit more over the course of the presentation. Those that deposit assets into a liquidity pool lock their assets, and they often earn fees and or automatically receive digital assets in the form of governance tokens. And these tokens give the holders the ability to steward and weigh in on certain aspects of how these protocols operate. The practice of submitting assets to a DeFi protocol is increasingly referred to as liquidity mining, and the process of earning fees and or governance tokens or other forms of assets is referred to as yield farming. So these are some new terms that you may hear more and more about, especially as decentralized finance grows.
And why are we even here? Why is DeFi significant?
Yeah, absolutely. And if we could turn to the next slide, that would be appreciated. So the reason that we're thinking about DeFi as a subcommittee and we spend so much time exploring it is that it's growing incredibly fast. Currently, there's about $14 billion in digital assets locked in various different decentralized financial products and services, and it's growing at an incredibly fast rate. If we thought about or looked at DeFi even a couple months ago or a year ago, the amount has ratcheted up from several $1 million to hundreds of millions of dollars to now over $14 billion. And increasingly, we're seeing kind of a dynamic emerge where over 10% of the amount locked in DeFi protocols is actually Bitcoin. So you're seeing Bitcoin being deployed into decentralized financial protocols, other assets being deployed into decentralized financial assets. And in a sense, a yield curve is developing around digital assets where folks can deposit them into decentralized financial products, earn fees or earn other assets, and develop a yield. and some of those yields are exceeding what may be possible to obtain through more traditional financial products and services.
Gotcha. And tell us a bit about some of the products and players involved in the DeFi landscape.
Yeah, absolutely. And if we can turn to the next slide. So the decentralized financial landscape is growing, and it's growing really fast. There's a number of smart contract-based protocols and centralized aggregation tools that are beginning to hit the market. So when looking at the emerging categories of DeFi protocols, there's a number of them. And we're going to focus in on a handful of them today during the course of the presentation. So in broad buckets, there's decentralized exchanges or DEXs. And DEXs have been around for a number of years now, but there's been some innovations that have led to a broader proliferation of DEXs. There's borrowing and lending protocols. There's derivatives and synthetic asset protocols. There's also insurance, prediction markets, and a number of others that I imagine we'll start to see emerge over the next 6 to 12 months. In addition, and on top of a number of these protocols, we're seeing other services emerge, including tools like DEX aggregators and also yield and asset management protocols. And we're going to unpack those in a couple minutes in more detail. And one way to look at it, and if you flip to the next slide, and this is one way to kind of conceptualize what's emerging. So kind of at the base, you have a blockchain like Ethereum or another blockchain, although most of the activity currently is happening on the Ethereum blockchain. You have a number of protocols that are smart contract based that perform certain financial functions like borrowing, lending, like exchanging, like derivatives and synthetic assets, like prediction markets, like insurance. And some of those protocols generate their own token. That could be a governance token or a stablecoin, or they interact with other digital assets that are tokenized or wrapped, things like wrapped BTC or wrapped Bitcoin, wrapped Ether, and a handful of other wrapped assets. And then on top of that, you're seeing services that interact with the below portions of the stack. So those include DEX aggregators, asset managers, yield aggregators. And feeding into this as well are a whole bunch of integration tools, things like crypto to fiat gateways, which enable users to deposit traditional fiat currencies like US dollars or euros or another fiat currency, convert that into digital assets, and then onboard user into decentralized finance. You're also seeing Oracle services emerge that provide data to some of these protocols, which enables more complex protocols to develop, also enables them to build more complicated things. We're also seeing emerge more, and this is a little bit more nascent, know your customer and or identity solutions, which are hoping to either address regulatory concerns or make it easier to interact with. And then there's various different token factories or other smart contract-based systems that enable the creation of assets like governance tokens, stablecoins, wrapped assets, et cetera.
And just so I'm clear on my understanding, we're effectively talking about self-executing applications that solely rely or mostly rely on software, source code.
Right. Yeah, exactly. At the protocol level, so self-executing is a bit of a misnomer, but they can be triggered by end users. They can send transactions into a blockchain, interact with these protocols, and these protocols are the ones that are automating the financial function. And in many instances, there's not one central party or a custodian that's managing that process.
Okay. And what are the benefits of these protocols?
And let's flip to the next slide, please. So, the creators and supporters of DeFi services often cite a number of benefits when describing or thinking about why they're developing these new financial protocols. One is lower costs. So the fact that you can automate a number of aspects of how a financial service may be delivered should over time indicate lower costs. Because it's available via blockchain and via the internet, there's a tremendous amount of accessibility to these tools. So regardless of where you are, if you're connected to the internet, if you have a wallet installed in your browser or potentially on your phone, you're able to access a number of these tools and services. That in turn leads to greater financial inclusion. So the fact that billions of people could potentially and arguably interact with these services could enable more and more folks to use these financial products and hopefully make their lives better. At the same time, to the extent that a decentralized financial protocol has a governance token, it points to a future where you could have community-run financial infrastructure with a number of stakeholders that are involved in that process. So making financial products and services look a little bit more like Wikipedia or a community-run organization as opposed to one run by a central party or a handful of people through a more traditional corporate structure. The permissionless access is also pointed out as a potential benefit, although that obviously cuts both ways, depending on your perspective. And another interesting benefit of decentralized financial products is that they're composable and interoperable. All of these different services, tools, smart contract-based systems, they're able to talk and interact with one another. They're able to be stacked together in different ways. Developers also oftentimes describe this as financial Lego blocks, where you can begin to, stack them together, build new products and services using some of these first emerging decentralized financial products and services as kind of base blocks to build more complex and interesting and potentially useful things. Also, because blockchains are sitting at the core of many DeFi protocols, and blockchains have, at least as of today, a fairly high security profile, that means that these services may have a higher degree of security. Also, because blockchains have cryptographic primitives baked into them, and because we're seeing more advanced cryptographic primitives interacting with or potentially going to be deployed on blockchains, they could provide a higher degree of privacy.
And what kind of risks are associated with DeFi?
Yeah, and let's turn to the next slide. So like everything, there's lots of benefits, but there's also a number of risks. And these risks are just emerging, and I think we're still trying to get a clear pulse on what these risks are. But one risk is that there's a very high barrier to entry here. Users need to be tech savvy to even interact with or operate these services safely. The software is very complex. It's more complex than otherwise already complex blockchain-based applications. That means you need to spend some time to understand how they work. You need to spend some time to understand the kind of core technical mechanics of how to interact with them. Although there's some commonality between a number of these services, some of these services enable the use of leverage, and leverage obviously creates its own type of risk. There's also questions about if there's runs on liquidity, so the assets that are being deployed into these protocols, if there's a pull or a withdrawal of a lot of that liquidity, will that create some sort of systemic risk or systemic problem? We're seeing a lot of growth here, but we haven't seen kind of a bear market or where things go wrong and lots of liquidity is pulled out. The fact that all these different protocols can interact and talk and be used to build more complexity also introduces entropy and some complexity related to the composability, which has led to certain hacks or complicated schemes that may be concerning and may create risks. And then there's obviously regulatory questions, which is the thrust of what we'll be describing and discussing during the rest of the presentation. There's also, and if we flip to the next slide, a number of growing pains, right? So DeFi is growing at an exponential rate, but there still are technical and practical barriers that have yet to be solved or have yet to be solved. One is there's a limited ability of blockchains today to process transactions. Now we're seeing some steady progress here with innovations like Ethereum 2.0. We're also seeing other ways to kind of increase the transactional throughput of blockchains through things like ZK rollups or zero knowledge rollups or other layer 2 solutions. But there's still a long way to go there, and it's not yet able to compete with more traditional, more centralized financial services and companies. There's also comparatively low levels of liquidity, at least when it comes to DeFi and as it compares to more traditional finance. And there's still questions about the security of the smart contracts themselves. So even though blockchain may be fairly secure, each individual system that relies on a set of smart contracts introduces its own risks and security vulnerabilities. And that also could lead to hacks and other thefts, and we've seen some early examples of that here too.
All right, let's dig down a little bit now on some specifics. Let's look at those decentralized exchanges, which you said have been around for a bit. How do they work?
Yeah, and if we flip to the next slide and then the slide after that. So DEXs are really interesting, and they've made some steady advances over the past couple of years. And at their core, DEXs rely on an automated market maker's smart contract or a set of smart contracts. And what that enables folks to do is trade digital assets without necessarily using an order book. So this is a little bit of a different paradigm that's emerging with decentralized financial protocols. So you can log into a basic website. You can decide which asset you want to trade or purchase or swap, and you don't necessarily need to have that trade routed through an order book. Decentralized exchanges are growing, and they're growing quite fast. So this is not on a necessarily every day, but we've seen DEXs or certain large DEXs actually have trading volumes that are beginning to rival custodial exchanges like Coinbase. And it's raising a question as to whether or not more and more activity related to digital assets will move to these decentralized exchange infrastructures and architectures. If we flip to the next slide, we can just start diving in on some of the technical aspects of decentralized exchanges. So like we described before, the way that these DeFi protocols operate is via smart contracts. And for most popular decentralized exchanges today, they rely on two smart contracts. One is an exchange smart contract, which holds a pool of one or more tokens. Sometimes it's two, sometimes it's more than that users can exchange. So this creates a liquidity pool, or kind of a pool of assets that sit there, which different parties can interact with, deposit tokens into, and pull out other digital assets when they're executing a trade. There's also a related factory contract, which is a contract that actually creates one or more exchange contracts and makes it easy to identify the various different liquidity pools that are going to be available on a decentralized exchange. So these two smart contracts work together. And if we flip to the next slide, we can unpack a little bit about why these are important. So these smart contracts matter because they enable the creation of these liquidity pools. And these liquidity pools lessen the need for an order book. So you're able to deposit assets into this pool and interact with these assets without the need to match people that want to purchase and or sell assets via an order book. Notably, there's no central administrator of the pool. It's maintained by the smart contract. So instead of having a trade or a swap cleared through a central party, the smart contract handles many of the technical aspects of that trade. These smart contracts are open and permissionless. So the factory and exchange contracts enable anyone to list a token to exchange. There's no central party that's assessing whether or not the token is a security, a commodity, or something else. There's no central party that needs to be interacted with in order to create a new liquidity pool. It can happen in a very permissionless way. And that's why these smart contracts are in many ways illegal. It doesn't mean that they're illegal. It just means that they've been designed to work at a technical level to enable the trading or swapping of these assets. They don't necessarily incorporate regulatory compliance into it. And that is a lot like how core blockchains work in the sense that they work technically, but they may create challenges when it comes to regulations. Next slide. Just to kind of unpack a little bit more, pricing on decentralized exchanges, it occurs algorithmically. So when exchanging one token for another using a DEX, users don't need to be matched with a counterparty via an order book, as noted before. Instead, a purchaser receives the requested token nearly instantaneously from the underlying liquidity pool. So instead of engaging in a peer-to-peer transaction, you're engaging in a pool-to-peer transaction. So you're interacting with this entire pool. And the exchange smart contract acts in a manner akin to a counterparty. So you're interacting with that smart contract and interacting with a pool of assets instead of an individual peer. The amount of a token that's returned from an exchange is based on this formula, the AMM formula, which often factors in the numbers of tokens in the pool at any given time. Next slide. at least as of today, because of the way that these DEXs operate, the larger an order relative to the size of a liquidity pool, the worse rate a party will receive under the applicable algorithmic formulas. Thus, the larger liquidity pools of a given token pair were set. This allows for bigger trades, and those trades, if there's a large liquidity pool, will have less of an impact on pricing. Next slide. What's interesting is that we've seen in the DEX ecosystem fairly stable pricing emerge, and in part that's occurring because there's third-party arbitrageurs that profit on any price disparity surfacing for a given liquidity pool. So these parties will make trades that go through different DEXs and also centralized exchanges, and the process of these third-party arbitrageurs is to create across the ecosystem fairly consistent pricing, particularly for widely traded assets. The protocols themselves also incentivize deeper pools of liquidity in a couple different ways. One is the underlying smart contracts award fees to those that provide liquidity. An example of a fee could be something like 0.3% for trade. They also increasingly award liquidity providers with governance tokens, which again grants those holders the right to weigh in on decisions related to the protocol's operation. Those could be decisions like setting parameters, setting the fees, setting other aspects of how the protocol and ecosystem may develop. And those governance tokens themselves are traded sometimes on centralized exchanges, sometimes on DEXs themselves, and some have a fairly high market caps, at least as measured by various different services and tools. Next slide. So interacting with decentralized exchanges, it will look a lot and feel a lot like interacting with any other website that you may view on your browser. But what's interesting about a number of these decentralized exchanges is that the website itself or the interface isn't being served from a central company. Instead, the website or interface is stored on decentralized file storage solutions like IPFS, and increasingly over time, things like Filecoin, which means that you may be viewing the interface from data that's come from a number of different people across the internet. So if you go to Google today and you want to run a search, at some point, Google Inc. is serving up that website to you. With DEXs and a number of other DeFi protocols, it's getting served up from lots of different people potentially across the internet and increasingly in that way. Now, that's not always the case. There's some decentralized financial products and DEXs that are being served up by the original smart contract developers, but increasingly that is not the case, and over time, I imagine that will be less the case as this ecosystem continues to emerge. Flip to the next slide. What's also interesting about DEXs is that there's very, very low barriers to entry. So the underlying smart contracts are generally licensed under open source licenses. And what that's led to is a number of competing forks or implementations of similar services. So there's some variations between DEXs, but because it's publicly available, the underlying software, and because it's very easy to set up a new DEX or a DEX with a slightly different implementation, we're seeing a whole ecosystem of them emerge. That means that liquidity providers are increasingly moving their assets to different DEXs. If one DEX, let's say, suffers a hack or has a problem, liquidity providers can move on to another DEX. Let's say that there was an enforcement action or some sort of regulatory action against one DEX. It would be easy to set up another one, and assets can kind of move towards these new DEXs. What that suggests, at least over time, and time will tell, but DEXs may become increasingly commoditized. This may just become kind of a base layer, and we may just see an entire ecosystem emerge around it.
Aaron, do you have an example of a DEX?
I do, and let's flip to the next slide, and we can kind of unpack that in a little bit more detail. So one of the most popular DEXs today is a service called Uniswap, and Uniswap is really interesting. It's really the pioneer of this mechanism where you can make trades without necessarily using an order book. And just to kind of unpack this a little bit, let's assume that I'm a trader. I am not a trader, but let's just assume that I am for purposes of this example. And I have a whole bunch of token A, and I'd like to receive back token B. I will be able to load up my browser, log on to Uniswap, and be able to obtain from this liquidity pool a price. And so this leads to a question: how is this price calculated? The way it's calculated is, again, through this automated market maker formula. And for Uniswap, that formula is quite simple. It's X times Y equals K, and it uses K, a constant, and the relative weights of the tokens in a pool to determine a price. So let's flip to the next slide. And I'll walk through kind of the math. So let's, again, assume that I'm a trader. I want to exchange some of the token A that I have for token B. In the liquidity pool at the moment, I'd like to make that trade. There's 1,200 units of token A and 400 units of token B. Under Uniswap's AMM formula, this would be represented as 1,200 token A, X, times 400 token B, Y, equals a constant of 480,000. If I, as the buyer, want to swap 3 units of token A for 1 unit of token B, and I'm willing to pay Uniswap's current 0.3% fee, then a new price can be calculated by keeping the variable K constant. In other words, the 480,000 K can be divided by what was initially in the pool, 1,200, plus the 3 units that I'm going to be adding, plus the fee. And since I'm taking 1 back, we can see that token B will be reduced down to 399. The relative pricing between token A and B before the trade was 3, but after the trade, it's going to kick up just a little bit to 3.01. And so this type of dynamic pricing can flow through the entire DEX, and this is how multiple users can begin to deposit and withdraw assets, but also get a bit of fair pricing. And again, that pricing gets impacted by the amount of liquidity in the pool, the size of the trades that individual users want to make, and various different other factors in other decentralized exchanges. Uniswap is just one example.
Great. And by the way, we'll have a break in this presentation very shortly to allow for some questions. How about lending protocols? Do you have an example of one of those?
Yeah, absolutely. And let's flip to the next slide after that. So in addition to DEXs, we're also seeing the emergence of various different DeFi lending protocols, and this is a very large category. So these protocols provide lending or borrowing-related functionality. Many of these protocols enable users to deposit digital assets into vaults and borrow another token back. So you can deposit, let's say, Ether into a vault on a decentralized lending protocol and receive back another token, let's say DAI or CDAI, in exchange. Some of these protocols create or aim to create a stable digital token through this borrowing and lending function, and some generate a rate of return. And some examples here are Compound, Aave, Maker. There's a whole bunch of other ones. Different other factors and other decentralized exchanges. Uniswap is just one example.
Great. And by the way, we'll have a break in this presentation very shortly to allow for some questions. How about lending protocols? Do you have an example of one of those?
Yeah, absolutely. And let's flip to the next slide after that. So in addition to DEXs, we're also seeing the emergence of various different DeFi lending protocols, and this is a very large category. So these protocols provide lending or borrowing-related functionality. Many of these protocols enable users to deposit digital assets into vaults and borrow another token back. So you can deposit, let's say, Ether into a vault on a decentralized lending protocol and receive back another token, let's say DAI or CDAI, in exchange. Some of these protocols create or aim to create a stable digital token through this borrowing and lending function, and some generate a rate of return. And some examples here are Compound, Aave, Maker. There's a whole bunch of other ones. Let's flip to the next slide. The way that these work is fairly simple. So a borrower deposits one digital asset into a smart contract and receives back another token, usually valued at an amount below what has been provided as initial capital. So the loan that's occurring through these platforms is denominated in another asset. So again, see die or die. And the amount typically received back by a user is between 50 to 75% of the deposited collateral. Let's flip to the next slide. So to ensure that a DeFi lending protocol has a sufficient amount of collateral, deposited collateral is auctioned or otherwise sold if the value of a given borrower's collateral drops below a liquidation ratio. The lending protocol often relies on outside data feeds, and we described those previously known as oracles, to determine the value of the collateral deposited by users into the smart contract system. This liquidation ratio is often set through community-run governance votes. So this kind of creates an incentive to make sure that there's enough assets at their core, at the base, for these protocols to operate. Let's flip to the next slide. Some, decentralized lending protocols are also enabling what are known as flash loans. And flash loans are very interesting, although a bit of a double-edged sword. So it's a loan that's only valid within one blockchain transaction. So on platforms like Ethereum, blockchain transactions can be reverted during its execution if certain conditions are not met. So flash loans take advantage of this functionality and fail automatically if a condition of repayment is not satisfied before the end of a relevant blockchain transaction. So you can take out a loan and repay it all within one blockchain transaction, and that's proved to be pretty useful for folks that want to take advantage of arbitrage opportunities or other types of trading opportunities. So another kind of new innovation that's emerging with some of these DeFi protocols.
Aaron, quick question. How do folks know what the rules, you talked about mathematical formulas, and AMAs when you talk about the DEXs, how do folks know what the rules are that apply to these lending protocols or these DEXs?
Yeah, well, in many ways, the smart contracts themselves set the rules. So to the extent that somebody is sophisticated technically, they can review and look at the underlying smart contracts and understand how they operate. Many of these projects are open source, if not all of them, and there's robust sets of documentation or other information that's available describing and detailing how they operate. So the rules are kind of there. The interesting thing about smart contracts, because once they're deployed onto a blockchain, they're hard to modify. You can understand the rules pretty quickly, and you know that those rules are not going to change over time unless there's some ability to upgrade those smart contracts. So the rules of the game are available, and by setting up these simple and or complex automated systems with rules that you know are not going to change or be modified, folks are able to interact with them with a degree of confidence and hopefully a degree of security.
Right. Earlier, you referenced derivative and synthetic protocols. Help us understand what these are.
Yeah, absolutely. If we could flip to the next slide. So there's also, and this is just beginning to emerge, so I'd say DEXs and also decentralized borrowing and lending protocols are the most robust, but we're also starting to see new derivative and synthetic asset protocols emerge. So DeFi protocols are not just limited to these exchanging and lending protocols. Some are also enabling the creation of synthetic assets that derive their value from an underlying digital or real-world asset. Many of these protocols rely on over-collateralization, like what we're seeing with borrowing and lending protocols, and oracles to maintain price stability. In some protocols, synthetic assets can be generated by any users of the platform. So a little bit like we saw with DEXs, where you could create any sort of liquidity pool to trade any form of assets. We're seeing open and permissionless derivative and synthetic asset protocols that may enable comparable functionality in this domain. So let's go through an example. We could flip to the next slide. So one example here is Synthetics. So Synthetics is a protocol that has a native token, SNX, that enables holders to create synthetic assets or synths, which can mimic any asset, but today it's mostly used to mimic other digital assets and or fiat currencies. So to generate synths, a user must acquire SNX, and they can do that by participating on the platform or by acquiring it on an open market. And they can deposit that token into the synthetic smart contracts, and in return, the synthetic protocol creates a new synth token of the user's choice. So just by way of an example, let's say that somebody wanted to create a synthetic version of the US dollar. They could deposit $1,000 worth of the SNX cryptocurrency and receive back $133 worth of SUSD, or synthetic USD. The way that the protocol works now, you need to lock 750% more SNX into the smart contracts than the amount of synth that you receive back. The pricing data is provided by an Oracle, a third-party Oracle solution, and there's lots of other kind of complex mechanics in how synthetics works, but this is the core of it. If we could flip forward to the next 2 slides.
And so that means you're going to tell us about aggregation layers.
I am. Yeah, so that's an overview of some of the emerging and I'd say the most mature DeFi protocols. But again, things are moving very quickly. So if we gave this presentation in a year, I imagine that we'll start to see even more and increasingly complex DeFi-related protocols and services that are beginning to be developed and have users that are interacting with them. But what's also interesting, and this really roots down into how decentralized financial products operate, because they're composable, because these services can be easily interacted with, we're starting to see additional tools being built on top and really a whole aggregation layer that's emerging. Let's flip to the next slide. And there's a number of aggregators that we're beginning to see. And so these aggregators make it increasingly easier for end users to interact with these new types of services. And they're all being built on top of these other DeFi protocols, as described before. So we're seeing DEX aggregators, yield aggregators, and asset managers. Flip to the next slide. So the first category are these DEX aggregators. And what DEX aggregators enable folks to do is access liquidity pools found on multiple different decentralized exchanges. And so some examples here are 1inch and also Paraswap. Flip to the next slide. What's interesting about DEX aggregators is that they're aiming to provide end users with better pricing. So instead of having to go to individual DEXs, you can go to a DEX aggregator and look across the whole ecosystem of DEXs to find the best price. So instead of other internet services today that aggregate, let's say, like news content or social media accounts or other types of information, DEX aggregators combine all this token pricing information across multiple DEXs and aim to provide the best price possible. They're able to do this without actually custodying any assets. So they don't rely on any custodianship of underlying assets by end users. The end users keep their assets in their individual wallets. They connect to these DEX-related services. They're able to find the best pricing, and then they'll interact directly with the DEX. These DEXs over time, and it's still too early to tell, but they could, in effect, serve as kind of a search function for DeFi. So if you want to go into DeFi, if you want to interact or trade one token for another, you may increasingly go to a DEX as opposed to going to an individual decentralized exchange. Although there's a possibility that the aggregators themselves may be decentralized, it looks like these may be centralized services that emerge. Another form of aggregator, if we could flip to the next slide, are yield aggregators. So we're starting to see users of DeFi protocols look to maximize their total digital asset returns through yield farming. And they're turning to yield aggregators to streamline the provision of liquidity and the earning of tokens or other fees. And one example here is Yearn Finance. Let me unpack that a bit on the next slide. So Yearn Finance is a very interesting DeFi protocol and service that's emerging. Participants deposit digital assets into the protocol smart contracts, and they receive back a governance token, YFI. The token provides holders with the ability to vote and invest in digital asset strategies through community-generated ideas. So people post up ideas, they vote on which ideas to engage in, and then the entire protocol helps facilitate that. The smart contract collects the proceeds from any of those investment strategies, and then we'll deposit that back to the Wi-Fi holders minus a fee. There's also a small group of folks that are called multi-sig holders that kind of ensure the security of all the proceeds that are collected, and they need to sign off on certain things before they're distributed. So it's a really interesting setup. It's kind of a community-run asset manager run in a very decentralized way without one party that's really handling either the generation of the ideas, the implementation of the ideas, with only a handful of folks that are sitting in the background, just making sure that things are secure.
All right, and before we break for some questions on this section, how about the decentralized asset managers? How do they work?
Yeah, so this is also emerging. So we're starting to see a handful of asset managers also popping up on the DeFi landscape. So because we've seen DeFi protocols grow, because we've seen a whole range of opportunities to begin to interact with these different DeFi protocols, tools are being developed to give people a way to track, manage, or hedge exposure to various different tokens. So some of these protocols bundle together different assets. So they'll take entire sets of assets and bundle them together and help manage them, or they just simplify the interaction with the underlying smart contracts. So you could, let's say, purchase an entire set of tokens or begin to kind of manage that process in a more streamlined way. So let me just describe on the next slide a couple of the core characteristics, and then we can just take a quick break to see if there's any questions. So a lot like DEX aggregators, what's interesting about decentralized asset managers is that they're non-custodial in nature, right? The control of the underlying asset is never transferred. It can interact with a user's wallet. It's composable, and these services also take advantage of the composability of these decentralized financial products. They can connect to a wide number of different DeFi products, ultimately creating an end-to-end experience. So for end users, these decentralized asset managers may be the front page. This may be one way that users interact with them. Just because they simplify it down, the user experiences are a bit cleaner, easier to interact with. Some of these services automatically rebalance under liquidate assets without additional user interaction, and they're globally accessible, right? These are tools that are available to anyone connected to an internet wallet. So that's a bit of a picture of kind of the emerging decentralized financial landscape, some of the core services and products that we're seeing emerge, and also some of the aggregation that we're seeing on top of it. We wanted to just take a quick break. I don't know if there's any questions, or we can dive into the next area. We know that was quite a bit to run through in a very short amount of time.
Hey, we'll open it up for questions. Aaron, I'll take the prerogative and ask one question here. This is Richard Gorelick. You noted early on in your presentation that these DeFi projects ideally do not rely on a central party, but in practice, many still do. What, from a governance standpoint, are some of these projects doing to ensure that they become or remain truly decentralized?
Yeah, so that's a great question, Richard. In many ways, they're pushing towards taking control of these protocols and providing them to the users of the platform through a governance token. So even though they may have initially created it, maybe they were making decisions on how these DeFi protocols would operate, they're hoping that in the long run, that the community of users, supporters, folks that are interested in the core underlying mechanic that's being facilitated by the underlying smart contract-based protocols will be managed by folks that hold these governance tokens. And over time, instead of it being managed by one single party, it may be managed by thousands, if not tens of thousands of different individuals. And there's been robust tooling that's emerged to make it easier to understand information related to how these protocols are governed, to weigh in if there's a vote or an issue that that's up for discussion and manage kind of the creation and maintenance of these protocols.
I have a question. What mechanism exists to kind of govern sort of these protocols on things like traditional like leverage ratios, as well as kind of implementing excessive fees? How do you what governs sort of how people behave in the implementation of these contracts?
That's a great question. It's going to really depend on the protocol. So different protocols enable governance token holders to set certain parameters. Sometimes the smart contracts themselves don't enable any flexibility when it comes to certain parameters. So it's really going to depend on a case-by-case basis. Another thing that's playing into governance, although it's not necessarily traditional governance, is some of these DeFi protocols, or almost all of them, are open source. And the fact that they're open source means that everybody kind of understands the core smart contracts that are being used. So if, let's say, one DeFi protocol is charging too high of a fee, or if one DeFi protocol doesn't enable communities to set those parameters, then we're seeing the DeFi protocol become forked, or a new version gets created. And then liquidity providers or other folks that want a lower fee, want more community participation, moving to this forked version of it. So in a sense, even if the governance is not provided directly by the construction of the DeFi protocol, the community is forking its way to something that gives more community participation and or potentially over time could lower fees.
Thank you. For the transcript, just so we can note that question came from Eddie Wen. And if anyone else has questions, please announce yourself so that it could be appropriately recorded for the transcript. Thank you.
Oh, this is Tim McHenry. I have a question.
Go ahead.
Since these systems, like the DEXs, are open source, how do operators prevent code manipulation, or how do they prevent others from taking advantage of vulnerabilities? Is there some peer review? Is that sufficient? Are there other controls in place, or is it just like you said, do users just move on to another service after a hack emerges?
That's a great question. So depending on the protocol, and again, this is on a case-by-case basis, many of the software developers that initially create them will have the software audited by a smart contract auditor. So these are folks that get paid and will do a security review, an audit, try to find vulnerabilities and assess for potential weaknesses. If there's a vulnerability that occurs, then either people are impacted by that in some negative way, or there's sometimes opportunity to upgrade it and to address that issue. And if there is an issue that emerges, or a pattern that creates a security vulnerability, people then try to improve it or kind of create another version that patches up that issue. So there are some teams that go through this auditing process. There are other teams that don't. They just release it, and they kind of figure out if there's an issue in the wild. And then if there's issues that emerge, improvements are either made directly by upgrading the underlying smart contracts or by creating a new version that may patch up that issue.
Thank you.
This is Jaime Werke. I had a question from FINRA. I had a question regarding, I guess, the use of the governance tokens. I believe I heard someone say that the governance tokens could potentially have a secondary market. Isn't there the potential for if the governance tokens are taken by parties other than the ones that are actually participating in the decentralized process, for there be a misalignment of interest such that those who are purchasing the governance tokens could do something nefarious?
Thanks so much for the question, Jaime. That's also a great question. So that is conceivably possible. So many of these tokens are trading on various different secondary exchanges. They're oftentimes awarded to users of the platform. So at least off the bat, those users are the ones that are weighing in on these governance-related questions. Some teams will allocate a portion of those tokens to the initial software developers themselves. Whether or not the software developers weigh in on decisions is still emerging. But to the extent that a party acquires a material position of a governance token, they'll be able to weigh in on these decisions.
Okay, are there any more questions at this point? Okay, Eric, Gary, it looks like we can move forward to the rest of the presentation.
All right, and so I'm going to start to ask Gary some questions about this, and let's turn to the regulatory and legal side of DeFi. If we could just flip to the next slide. So Gary, so we've talked about the overview of decentralized finance, how it works on a technical level. Let's begin to dive in on some regulatory questions. So in the U.S., what regulators and laws may be implicated by DeFi?
Well, and thank you, Aaron. There's nothing unique about DeFi as far as the applicability of applicable laws and regulations. So, the common denominator of most things out there is that if it's the same business, the same risk, you typically get the same laws applying. And that's exactly the case in DeFi. So in theory, to the extent that anything that DeFi touches is governed by an applicable law or rule today, then obviously the regulator that's responsible for enforcing that law is obviously involved in the process. It's interesting if you go back to one of the first regulatory looks in the DeFi space. It was actually one of the most famous reports. It's called the 21A report, issued by the SEC in connection with a DApp known as the DAO that was issued in July 2017. And effectively, the DAO was a DApp that was going to effectively reward or pay for projects that were going to be funded by persons. I'm not going to get into the whole gist of that, which is that the DAO token itself was deemed to be a security by the Securities and Exchange Commission. But right in the first sentence or the second sentence of the DAO report was a discussion of who might be responsible for a regulatory breach. The DAO itself was an unincorporated organization. There was a corporation that introduced the DAO, known as Slocket UG, which was a German corporation, and it was identified as a potential person responsible. There were co-founders, 3 co-founders of Slocket. They were considered to be potentially responsible. And there were a bunch of unnamed intermediaries. Folks known as curators who would actually be potentially looking at some of the projects that might be funded by the DAO. Because it was a report and not a enforcement action, the SEC never really gave its view on actual liability there. But it was the first effort to try to figure out who would be responsible, who could be responsible for effectively a unincorporated entity. And that's really what a smart contract is all about. A smart contract it's just code. And typically it's the smart contract that's the actor that's potentially violating or doing something to contrary rules. So if we just look at the CFTC, the Commodity Exchange Act and the CFTC rules, obviously, if there were unregistered FCMs or DCMs or CEFs or DCOs, theoretically those are regulatory issues. If there was fraud, that's a regulatory issue. If there was, manipulation or deceptive devices, that's a regulatory issue. CPO, CTAs rules are touched by potentially some of the activities of DeFi protocols. And then, as we saw in a recent complaint against BitMEX, the CFTC has basically said if you were supposed to be registered as an FCM, then you have a duty to supervise. So all these issues under the CFTC are touched by DeFi. Elsewhere, and indirectly under the CFTC, potentially, Bank Secrecy Act, state money transmitter laws, other state laws such as the New York Bit License, or the soon-to-be fully rolled out Louisiana Virtual Currency Act. These are also laws and rules that could be touched by DeFi. And then, again, looking over at the SEC land, you've got Securities Exchange Act, Securities Act, Investment Advisor Act, all the rules that apply, again, to ordinary, issues. DeFi does not get a safe harbor. Now, if we can just turn the page, the issue, though, again, the difficulty, one more page if we could turn, the difficulty is imputing liability to somebody. The somebody is could be the initial drafter of the source code. Generally, in the United States, software development is a protected activity under the First Amendment. And unless there's absolutely no lawful purpose to the software, but that's not the case here, as Aaron has eloquently shown. There's many valid uses for DeFi. Now, the First Amendment is not an absolute bar. There's case law precedent. United States v. Mendelsohn is a good example, where software was sent from Las Vegas to California. Effectively was code on a floppy disk that related to sports bookmaking, and that was held so integrally related to the bad act that folks were held liable for that. But in general, again, just writing source code is considered protecting speech. The other issue is that even if you were to do something against a developer, the code still is out there. It doesn't go away. The smart contract is still running, and as Aaron has mentioned, it's subject to forking, copying. It's source code. Somebody else can take it and run with it. So it is a difficult issue of if there is something that's a problem, who is potentially liable. And as Commissioner Quintens himself has noted, enforcing CFTC regulations against smart contracts does not immediately stop activity from occurring because individual users can continue to use the software. That's on the next slide. The only potential here is that and one more slide through, as Commissioner Quintens has also noted, that if developers can reasonably foresee at the time they created the code that it might be used by persons violative of CFTC regulations, then you might have some potential liability there. There's also, ancillary action. There's ancillary actors that somehow may be, part of the original, uploading of the source code and running of the source code. There may be some folks who, maintain the sole interface, the underlying smart contract. There are folks that may maintain control over core mechanics of how the service operates. And then there's potential deployment of the source code itself, and obviously those are folks that might be looked at by regulators.
Yeah, and so this, I guess, raises the question, right? If something goes wrong, how does this kind of overviewed, how would the government or the CFTC prosecute a code, and raises the question, where may liability lie? And so the question could be direct liability, like Gary suggesting, against software developers, although there's challenges there. But besides direct liability, Gary, is there anything else that could be considered?
Sure. I mean, there's obviously
find inspiration in a new Mazda CX-30 with class-leading horsepower.
One of the things on the direct liability, because there has been one interesting case brought by the SEC It was a case brought by an individual, Zachary Coburn. This happened, against Zachary Coburn. He was the one who wrote and deployed the smart contract on Ethereum and exercised complete control over it, known as Ether Delta. And Ether Delta basically operated as a DEX without requiring registration. Ether Delta, as I said, was a smart contract. It executed orders. It did a lot of the things that you described, but according to the SEC, it wasn't registered as an exchange, and that was a major problem. Because Mr. Coburn presumably was so involved in the rollout and running of this smart contract, he himself personally was named. And Ether Delta was not even named in the caption of the case because it didn't exist as a legal entity. He was required to disgorge as part of a settlement. He was required to disgorge theoretical profits, fees that he had made, and sustain the fine. But that's an example where somebody was so individually identified with the smart contract that allegedly had volatile qualities that it was easy to go after. In other cases, there's potential secondary liability, and this is where things get a little bit more difficult. Under the Commodity Exchange Act, as this audience well knows, there are two key elements: aiding and abetting liability, and we can turn the page on that. Or two pages, Hank?
2 slides, yeah.
Yep. One more slide. One more slide, Phil. Sorry. All right. There's aiding and abetting liability and controlling person liability. Let's turn to the next page, sort of as a refresher. I mean, aiding and abetting, if a person commits or willfully aids or abets the violation of any Commodity Exchange Act provision or CFTC rule, or acts in combination or concert with any other person in such violation, or willfully causes an act to be done or omitted, which, if directly done, would be a violation, then that person could be held liable as a principal. This is a provision of law that the CFTC often relies on. And then there's also, obviously, the next page, 13B, which is controlling person liability. Any person who directly or indirectly controls any person who has violated any Commodity Exchange Act provision or rule may be held liable for such violations to the same extent as such controlled person. Now, this is a little trickier. The CFTC has the burden of proof on this, and they have to show that the controlling person did not act in good faith and knowingly induced directly or indirectly the act constituting the violation. But these are two very, very strong provisions. Next page. Recently, the CFTC settled an action, Edge Financial Services, and this was a case in which a company and its employees, were held, or it was a settlement. It was an action where the charge was that the company aided and abetted an individual who had engaged in spoofing by programming, back of the book functionality that enabled that spoofing. That was the allegation. Ultimately, the CFTC charged aiding and abetting for spoofing and aiding and abetting for manipulative and deceptive device provisions of the law and the rule. So, this is obviously a tool that the CFTC has.
So there's obviously different theories of secondary liability that could attach here, but where would that secondary liability attach, Gary? And how do you assess the costs and benefits of extending secondary liability to these actors?
Well, there, as you mentioned, there are a lot of folks that are involved in the DeFi universe. There are the liquidity providers, there are the end users that participate or potentially facilitate conduct. There's the holders of governance tokens who might be construed to have a controlling interest over the direction of the underlying software. Although we're on the next slide. There are multi-sig holders for certain applicable projects that have the ability to control activity. And then none of any of this stuff occurs without the validators or miners on the blockchain systems that actually formally execute the smart contract by validating all the transactions and letting them proceed. So there's a large group of persons that are involved in the DeFi ecosystem that can potentially be brought into the process. But again, the problems with naming any of these persons is that and we go to the next slide, they're incomplete solutions. Secondary liability may only serve as a deterrent, but will not stop the use of the DeFi protocol due to the nature of smart contracts and the difficulty of modifying, let alone stopping their running once they're started. The other thing is that the cure may, the supposed cure may cause unintended consequences. It may encourage developers to use more advanced forms of cryptography to obscure transactional records. And likewise, the enforcement costs can be very, very great, depending on the legal theory, and a lot of the stuff will be untested. It could be great cost to go after particular defendants. There's also a certain fairness element in it. Miners and validators are likely the folks that make the system go, but they are probably in the least good position to actually understand and assess the legality of each particular transaction, because the miners and validators are validating all transactions on the blockchain, and they're just looking to see that certain technical rules are being complied with that allows blocks to be closed and added to the existing blocks. So that's a sort of a very, very difficult situation. So let me turn to you, Aaron, and ask you, is there a path forward to address these regulatory concerns and concerns about liability on potential actors?
Yeah, that's a great question. If we could flip forward, I think, 2 slides. One more. Yeah, and one idea that we discussed in the subcommittee was a potential safe harbor. If we could flip to the next slide. So an alternative approach, or one that can complement potential actions brought against actors for secondary liability, could be a safe harbor. And the notion here is that a safe harbor could potentially create a regulatory incentive to build and support compliance. So it could excuse either direct liability against software developers or potentially other DeFi participants if, as an example, the protocol has a lawful purpose and entails no fraud, it interacts or excludes addresses under jurisdictions encouraging OFAC compliance, and limits or bars margin trading. And these are just some examples. There could be other factors that need to be addressed in order for a safe harbor to apply, but this is just a couple ideas that could occur here. And in many ways, this notion of using a safe harbor is grounded in the past. But I just wanted to flip to the next slide and just address one other point that's worthy of consideration. So the safe harbor also could contemplate requiring that protocols are able to implement any future CFTC authorized software systems to enforce commodities-related laws. So this is an interesting concept, a concept I've written about in the past and other folks are beginning to contemplate, but it's actually using software that's provided by a regulatory body like the CFTC to enforce laws. So using software systems as law, as opposed to only letting the rules embedded in these smart contract-based systems dictate how they operate. So a safe harbor could also encapsulate that. While regulatory bodies today may not be ready to implement some of the rules as software. Over the longer arc, my sense is we may see more and more regulatory bodies moving in this direction. And this notion of a safe harbor is grounded in history. In many ways, we began to discuss this as a subcommittee due to some lessons from the, quote, copyright wars that occurred during the first wave of the internet. If we could flip to the next slide. And with these copyright laws, we saw during the first wave of the internet, copyright law evolve via the common law to grapple with peer-to-peer networks. What happened was when it came to copyright jurisprudence, we saw courts create and articulate expanded theories of secondary copyright liability. And in many ways, the media and entertainment industries were the first industries to grapple with peer-to-peer networks and peer-to-peer technology, which is roughly analogous to what's happening in the blockchain ecosystem. So let's just unpack what happened there. Turn to the next slide. So through various decisions at both the Supreme Court and at circuit courts around the country, vicarious liability or secondary liability is now imputed on online platforms that exercise requisite control over direct copyright infringement and also derive a direct financial benefit from that infringement. Requisite control has been determined to be a legal right to stop or limit the directly infringing conduct, as well as the practical ability to do so. It attaches even if a platform lacks knowledge of the direct infringement. We flip to the next slide. We've also seen a new theory of contributory liability that attaches to online platforms that induce or encourage intentionally copyright infringement. We've also seen contributory liability attach when operators have actual knowledge of copyright infringement and fail to take simple measures to prevent further damage. So between vicarious and contributory liability, we've seen courts be able to grapple with some of the complexity of peer-to-peer platforms like Napster, like Rockster, like LimeWire, and a whole host of others by extending liability to the folks that are running these online platforms if they have the ability to actually take simple measures to prevent further damage, if they're intentionally encouraging infringing behavior, or if they have the ability to profit and can kind of control the entire ecosystem in some sort of way. Let's flip to the next slide. At the same time, and this kind of complemented what occurred in the courts with expanded theories of secondary liability, through a treaty, the Digital Millennium Copyright Act was enacted, and the DMCA does lots of different things. But one thing that it does do, it's resulted in the development of a notice and takedown regime, and this notice and takedown regime encourages online platforms to respect copyright holders' rights if they are notified by a copyright holder of potentially infringing content that's on the platform, and they expeditiously remove that work, then they're able to avoid potential copyright liability. And this notice and takedown regime, while there's issues with it, at its core, it's enabled large platforms like YouTube, Spotify, Wikipedia, and other services to grow while attempting to balance copyright owners' concerns. So it's been, in a sense, able to thread the needle where completely infringing platforms or peer-to-peer networks that are not trying to respect copyright owners' rights are able to be addressed through courts or through other actions, while at the same time, companies, products, and services that are trying to respect copyright owners' rights, like YouTube, Spotify, and also Wikipedia, are able to flourish and have some clarity as to what their liability may be. Maybe we can flip to the next slide. One thought here is that a similar approach could be adopted. Decentralized finance could be regulated using theories of secondary liability under the Commodities Exchange Act or other related financial statutes. At the same time, a safe harbor, if implemented, could ensure responsible development to protect consumers' interests, to make sure that folks are not being harmed without limiting innovation, so that the U.S. Can make sure it remains on top when it comes to building and developing and supporting new financial innovation. So we thought that this lesson from history was interesting, something worthy of consideration. Kind of the scope of what a safe harbor could be would obviously require a lot of thought and a lot of input before implemented, but we think it's potentially a fruitful path forward. I know, Gary, you have some thoughts here, so I don't know if you wanted to weigh in.
Yeah, I mean, I do think this is this is sort of a Scylla and Charybdis, and it's a difficult navigation because obviously there are a lot of folks, and I hate to use the bricks and mortar enterprises in the blockchain ecosystem, that have spent a fair amount of resources trying to get it right from the beginning, and making sure proactively they did what they needed to do to comply with applicable rules and law. And there's also folks who have absolutely avoided, certain markets, including the U.S., because they recognized that there were, difficult issues, and they didn't want to deal with them, and so they avoided the marketplace and avoided opportunity for revenue, in order to, not get in trouble with the regulators. What's challenging here, and what makes this thing so difficult, is that it is effectively, non-legal entities that are ultimately doing whatever the activity is that may be adjudged incorrect, and so at the end of the day, it mostly will be secondary actors that are potentially liable. And it's a challenge to get at them, and it raises issue of fundamental fairness, in my view. But that being said, the difficulty here, it's the same issue of granting someone an opportunity to work in a sandbox, as they have in the UK or some other jurisdictions. If you give folks a safe harbor, you're effectively penalizing people who have incurred the cost of compliance and or avoided the situation of non-compliance. There are ways, in my view, that the CFTC doesn't have the authority to issue something like a 21A order, but they can do a combination of no action letter and a public solicitation of comments in connection with a proposed guidance, much as they did with the actual delivery guidance recently issued, where they solicit a wide range of input to figure out a way to go forward. But Aaron, I think you are right, and many members of the committee are very sympathetic to the issue. Is that this is an important development. This is a game changer. The idea of having non-incorporated entities, non-legal persons, non-actual persons, engaging in the activity that might be problematic, is a relatively significant game changer that hopefully, as we've made clear, has lots of benefits out there, lots of potential benefits, but obviously has a lot of risk. So we need to tread cautiously in this area, but we don't want to inhibit this important development. So what's our final thoughts, Aaron?
Yeah, and let's flip to the last slide. And thanks so much for everybody's time and attention. So in kind of conclusion and some further considerations, given the emergent nature of DeFi, given the fact that it's grown significantly over the past year, and we have yet to see any signs that it will stop growing, the subcommittee is considering future recommendations to the TAC to recommend to the CFTC various different things. In our view, the subcommittee's current thoughts include adopting a wait-and-see approach to see where risks manifest with these protocols, to carefully consider whether to impose direct liability on smart contract developers and/or miners or validators to prevent spillover effects, and also, as Gary noted, to just consider with those types of actions the level of fairness that would be applied, particularly if there's a thought to apply liability on miners and validators. To research and explore theories of secondary liability. While it's been used in the past, I do think that as applied to decentralized finance and thinking about ways in which these theories can develop, more thought needs to be applied there. Obviously, continuing to engage with blockchain developers to stay up to date on new services and ongoing innovation. The presentation today outlined a handful of protocols that are emerging, and they're becoming a bit more mature. But there are new DeFi protocols being deployed that folks are interacting with on a near daily basis. And I don't think we're just seeing the endpoint of DeFi, but rather just the beginning. So there's going to be a number of new services, including new services that expand into options and a whole bunch of other financial products. And as Gary mentioned before, consider having the staff memorialize a safe harbor in a no action letter to the extent that seems like a fruitful direction to go. So that is kind of our conclusions and considerations. Thanks so much for everybody's attention, and we thought we'd open it up to see if there was any further questions.
Thank you, Aaron and Gary, for your presentation. I'd now like to open the floor for questions and discussion regarding the presentation. Okay, maybe you've answered everybody's questions. I'll make one last call, and then we'll move on if there are no questions. Let's move ahead then. Thank you, everyone. Let's take a quick break. I think we'll take about a 5-minute break here before the tech vote on a recommendation from the Cybersecurity Subcommittee. Once again, I'd like to thank Aaron and Gary. That was a fascinating presentation. I learned a lot, and I'm sure everyone else did as well. Thanks, guys. Take a quick break. Be back in 5 minutes.
So that was pretty cool, everyone. I'm going to take a break too, so I'll be back in a bit.
Hey, it's Megan. Hunter and Jerry, are you on? I think the public hears music right now, so we can speak.
Okay, great. Hi, this is Jerry. I'm on.
Yes. Yeah, this is Hunter. I'm here as well.
Okay, thank you so much for doing this. So we have a 3-minute break, and then at like 11:15 Eastern time, we'll come back and let me go over a series of events for you guys. So Richard's going to announce the vote. He's going to give a little background and introduce both of you. And then you'll speak and just give an overview of the vote like we discussed. And then Richard will open up the floor for questions in case the TAC members have any. And then if not, we'll move to the vote. Richard, are you clear on all of that?
Yes, I am.
Okay, perfect. Hunter and Jerry, are you all set?
Indeed, yeah, I think so. We were just going to, not go into detail, but just do a very quick recap.
You didn't rewrite everything in light of the news from last night?
I'll try to weave it in a touch, but not much.
Yeah.
Richard, the only question I have for you is, since we're not in person, I think you make the motion for the vote. Oh, hold on 1 second. presenters.
Perfect. Thank you, Megan. As our last matter for the morning, the Technology Advisory Committee is going to vote on a recommendation from the Cybersecurity Subcommittee. The Cybersecurity Subcommittee is going to be recommending that the full Technology Advisory Committee makes a recommendation to the CFTC that it provide clear, concise, and up-to-date guidance on how the CFTC reviews highly sensitive cybersecurity artifacts and sensitive intellectual property. Tech members were provided with the materials for the vote in advance of today's meeting. In addition, the Cybersecurity Subcommittee presented on the background to this recommendation at the last TAC meeting in July of this year. Before I open the vote, two Cybersecurity Subcommittee members are going to briefly reiterate and explain the recommendation. They are Jerry Perullo, the Chief Information Security Officer at ICE, and Hunter Landrum, the Government Affairs Counsel at 2 Sigma. Jerry and Hunter, I'll turn it over to you.
Thank you very much. We greatly appreciate the opportunity to speak today to briefly recap our discussion from the TAC meeting in July. As we discussed at that meeting in July, regulated financial institutions, including providers of critical national economic infrastructure, have identified significant risk in the collection, concentration, storage, and securing of highly sensitive cybersecurity artifacts and sensitive intellectual property during regulatory examination procedures. In recent years, these concerns have been buoyed by actual breaches that have occurred at several national regulatory agencies. Now, to date, various national and international regulators have taken different stances toward the collection of this data. Jerry, could you discuss a bit more?
Sure. Thank you, Hunter. Yeah, so being a large multinational and dealing with many different regulatory jurisdictions and different regulators around the world, we really get to compare the way behaviors vary, including here within the United States. And so, I wanted to flag that the Commission in particular has actually been very agreeable and very practicable when it comes to dealing with this issue. And we deal with both on the clearing side as well as the market side. And what I mean by that is that when asking for particularly sensitive data, such as penetration test results that may show our vulnerabilities or inventories of systems and diagrams, the Commission has been very agreeable to view those artifacts at a shared location, take all the notes they want, that sort of thing, versus taking them away. And we enjoy that. And the real push here is to say, let's codify that and to protect both the critical infrastructure entities as well as the Commission itself when it comes to housing these artifacts. And by way of contrast, I'll note that other agencies have asked firms like ours to produce and transmit over into their care things such as not only the diagrams and vulnerabilities I mentioned, but even things like the usernames of individuals or privileged access to systems. And things can get pretty forceful pretty quickly in a regulatory relationship, and that jeopardizes really the whole ecosystem. So all this vote is really asking for is to have a review performed and to codify some of those behaviors and practices so that things don't change in the future and that examiners are still able to access the data that they need. We don't want to dilute that in any way, but they're able to do it in a secure manner by minimizing taking possession of any of these artifacts where it doesn't directly contribute to the cause here. And then lastly, I'll mention just for the sake of a quick update, many of us in the cybersecurity world, especially in financial services, overnight have been working on a breaking breach at a third party. And it's a vendor that apparently was compromised during the year, and we're learning that led to the compromise of additional vendors as well as U.S. government agencies specifically. So a lot of you will have woken up to this news this morning. And I think this is just exactly illustrative of what we're talking about here with third-party risk. And it's just near impossible to secure every single avenue, and rather the tack that all of us take in the private sector is to just simply limit the amount of data that needs to live outside of our walls to avoid these issues where it's really not directly helping the relationship. And so we're just asking that the Commission, as well as other regulators, value that approach and support it where it doesn't get in the way of their examination responsibilities. So thanks again for hearing us out.
Thanks, Jerry. And as Jerry noted, the CFTC has dedicated itself to this concern and continues to be a leader in addressing this issue through the TAC and through Commissioner Stump's specific initiative on data protection. But as we said, the lack of policies and procedures today to determine when and how sensitive information is securely reviewed continues to make the process ad hoc and more difficult both for CFTC staff and market participants. So we would urge you to take this vote today to provide clear and concise as well as up-to-date guidance on how the CFTC should interact with these cybersecurity artifacts and sensitive intellectual property. And we would also encourage the Commission to move forward on the topic to provide clarity and reassurance to the marketplace. So thank you very much for the time and attention on this issue, and we're happy to answer any questions if there are any before the vote.
Thank you, Hunter and Jerry. Do any TAC members have issues to discuss with respect to the vote at this point? Okay, hearing none. With that, I now move that the TAC adopt the recommendation from the Cybersecurity Subcommittee on making a recommendation to the CFTC that it provide clear, concise, and up-to-date guidance on how the CFTC reviews highly sensitive cybersecurity artifacts and sensitive intellectual property. Is there a second?
Second, DeWall.
Okay, thank you, Gary. I now will call for a vote on the motion. I'll ask all TAC members to unmute themselves at this point. All those in favor of approving the subcommittee recommendation, please say aye.
Aye.
Aye. Aye. All those opposed, please say nay. Any abstentions?
Yes,
Okay,
Richard, NFA, this is Tim McHenry. I have to abstain because of our regulatory capacity.
Okay, great. Duly noted.
Thank you.
Thank you. The motion carries. And thank you, everyone, for the work on that. That will be very helpful. Okay, so now we will move to closing remarks.
Thanks, Richard.
Yep, go ahead, Megan.
Okay, so now that concludes the presentation and the vote for the TAC meeting. We're going to move on to the concluding remarks, like Richard noted. Commissioner Quintens, would you like to go first?
Thank you, Megan. I don't have any official closing remarks other than to specifically thank Aaron and Gary for the great presentation that they gave us. Lengthy, in-depth, insightful, helpful, very clear. Hopefully it will be a springboard for anyone who wasn't very familiar with DeFi before that to further educate and update themselves in this fascinating and fast-growing area that's obviously providing value and excitement, but is posing questions that would better be cleared up and ensure does not jeopardize that value and growth. So specifically like to thank them. Thanks again to all the TAC members and subcommittee members. Richard, thank you for your leadership, and thanks to all of our CFTC staff, Megan, you in particular, and appreciate the my fellow commissioners joining us. Thank you.
Thanks, Commissioner Quintens. Chairman Tarbert, do you have any closing remarks? Chairman Tarbert might have had to leave the meeting. Commissioner Benham. Commissioner Stump?
Thanks, Megan. I just wanted to echo the things that Commissioner Quintens said. I personally always find these meetings to be extremely beneficial, and in particular, the two subcommittees that presented today have been tasked with providing input on things that I personally have found to be a struggle over the past couple of years, and it is just a result of the fact that our markets are constantly changing and evolving. And I'll start with the second presentation first. Data protection is extremely important to me, and I
thank the subcommittee for all of their efforts to try and help us as an agency to ensure that we have all of the right metrics in place to ensure that the data we take in or the data we require is properly protected. With regard to the first presentation, I just wanted to say I found it extremely timely. There was discussion about the manner in which we apply our regulations in this vast new world, which is not how we would traditionally have applied our regulations. And each year when I'm considering a number of enforcement cases, I often find myself thinking through some of the questions that were raised in today's presentation with regard to secondary liability and the manner in which we exercise the authorities we have to ensure market integrity, but also preserving innovation. So I just thought it was a really great presentation, and wanted to thank the presenters and the subcommittee. And again, wanted to thank everyone who had a hand in organizing today's meeting. Thanks.
Thank you, Commissioner Stump. And Commissioner Berkowitz, any closing remarks?
Yeah, thank you, Megan. And I too, like to thank the participants. Very, very informative presentations. I would just note, I'm very much looking forward to the committee's further thoughts on the issues such as you were talking about safe harbors and what the Commission's regulatory responsibilities should be in this area. So I very much appreciate the committee taking the initiative on this. I would just note that Section 3 of the Commodity Exchange Act, which outlines the findings and purposes of the Commodity Exchange Act, in addition to promoting market integrity, one of the fundamental purposes is to promote responsible innovation and fair competition. And I think the presentation in one of the slides was talked about how to balance those or maximize both of those objectives. We want to encourage innovation. Some of the technologies described here today really at the forefront of the markets. At the same time, we want to maintain fair competition among all market participants, those who have new methods of competition as well as those who are employing the traditional methods of competition. So how we achieve and maximize those objectives is something we must always try to do, and I look forward to the committee's further advice, recommendations, and information on that matter. So again, thank all the participants for today's excellent presentations.
Thanks, Commissioner Berkowitz. And Commissioner Benham is having a little issue with his line, so we're going to give him one more minute to hopefully get on. Okay, he can't get the line to work, so he'll pass. But with that, thank you, everybody, once again. Thank you, Richard. And this meeting is now adjourned.
All right, everyone, there you got it. Directly from the CFTC. We'll keep updates on this for future events, too. See how they're proceeding, but it looks like they're definitely looking at the regulation with DeFi, pretty much all DeFi, and DEXs too.
That does conclude today's conference. Thank you for participating. You may disconnect at this time.
So it'll be quite interesting what happens in the next couple of years with the regulation with some of these blockchains that are out there right now. But it looks like they're definitely going to be regulated. But thanks a lot for joining this call. Might have a real event maybe a couple weeks or so from now, maybe January. LA Fintech, downtown LA possibly. Some places that are open in Pasadena right now and Orange County, so we'll see. But thanks a lot for joining, everyone. Please share this with your friends, other crypto people that you know, because this is the latest developments in the crypto space with what the CFTC is doing, and also SEC and the regulation going on with it too. Thanks a lot.